No.
Can you see my screen?
Yeah, looks good.
Okay. And my pointer?
Yes.
Cool. So thank you, David, for putting on the show. Thank you, Anka, for organizing and all the things that you guys do. I have been trading for 52 years, which is a pretty long time. And during this period of time, I've learned a lot. One of the things I learned was this: don't believe anything anyone tells you, including me, until you see it for yourself. That holds true not just for the markets, but for everything in life. There's a lot of information about the markets, more and more information all the time. Before the pandemic, if you went to the internet and did a search on the term "teach me day trading," you got about 415 million, that's a million, hits. During the pandemic and after, you get about 2.6 billion hits. What the hell does that mean? It means that everybody and their brother wants to be a day trader. They want a short-term trade. They want to use the markets. They want to trade options. The good news, there's a lot of information out there. The bad news, there's a lot of bad information out there, and most of the information available is not accurate. Now, let me say this. I'm not an options guy. Oh, I totally understand them. I just don't use them. There are so many people in the business like Price who are so much better at options than I am. So I can't help you with that. But what I can help you with is timing and trade selection. If you've selected the right trade and the right timing, there are many ways in which you can put that information to use in the markets, whether it's options, option strategies, straight stocks, binary options, you name it. So my expertise is picking the right trades at the right time. Fortunately, I've been successful. I've had a brilliant career. And the good news is this: I have nothing to sell you today except some ideas. In fact, it's even better. What I have for you today will not cost you $97, $997, or anything. It will cost you $0 to see what I do. I'm a numbers guy. Everything I do must be by the numbers. Why? Because for the first 15 years that I traded, I didn't realize the importance of numbers, the importance of knowing exactly what to do, strictly by the rules, absolutely clear, no interpretation, nothing ambiguous, no opinions, no looks like, none of that. The only thing that makes me happy when I teach something to somebody is this: that you and I reach the same conclusion about the same trade, independent of one another, and we agree on everything exactly the way it should be, based on the rules that I use and based on the rules that I teach. So it's important for me to achieve the following goals. If you're making money, I'd like you to make a lot more. If you're losing money, like most people are and will, I'd like you to turn that around and start making money. If you're making a lot of money, then you don't need to be here. So I do everything I do completely and with clarity. The other day, I got an email from someone, and I've been getting many questions about this from people. Jake, why have you been saying in the last year or so, don't day trade? I'm saying that because day trading is now the most difficult thing you can do. You're competing against the most experienced traders and machines in the world. The machines are taking over everything. The best time frame for me is 3 to 5 days, maybe a little bit more. So I can relate to many of the options that Price showed. If you're going to be day trading and you want to sit in front of that stupid computer all day to make a few bucks on a trade, then you better make sure that you're trading large positions, because that's the only way you're going to do that. Now look, this advice about day trading is coming from the guy who wrote the 4 best-selling books on day trading for McGraw-Hill. So it's not like I'm a newcomer to day trading. I've traded, and I should say day traded tens and thousands of times. But when I get to be my age, or when you get to be my age, if you're not already my age, or no matter what age you are, the most precious thing you have is time. You need to maximize that time and do it effectively using the right strategies. So I'm going to show you a few things today that are rather interesting to me. And here's the first one. Let's forget about what this chart is. Let's only look at the bottom of the chart where it's showing some green. In addition to the green, I've shown some blue arrows. And I want you to look at this chart. Spend a few minutes while I'm shooting my mouth off and check it out. If you notice the chart and you look at the relationship between the green areas and the arrows and the price, you will notice that in almost every case, the green area appeared at the bottom of a move or preceding the beginning of an up move. One of the biggest moves in the history of this market here, another big one here, another big one here, and so forth. So the record of this indicator, for lack of a better term, is stellar. It's not perfect. Sometimes it starts to buy before the bottom, continues to buy through all the way down, and then averages its price and participates in a big move up. So what's the bottom line? What is the indicator? I will show that to you momentarily, but let's take a look at another chart. We'll look at another chart momentarily. Just a little bit about who I am, and you can read this later if you get the PowerPoint. There's a lot of stuff I've done in my life. Written about 45 books by now. I'm a real trader. I trade what I teach and I teach what I trade. Everything I do is purely technical, by which I mean I don't care about the COVID news for my trading. I don't care about who said what. I don't care about opinions. I don't care about reports. I don't care about government situations. I don't care about any of that stuff. My work is strictly by the numbers, and you will see that. Everything I do is computer-based and tested. I've taught thousands of traders one-on-one and in groups all over the world. I've been at about 860 seminars and webinars. I'm a member of the Foundation for the Study of Cycles. I've been on Wall Street Week, CNN, CNBC, FNN, and you name it. The good news, I'm not a broker, and everything I do, as I said, is completely objective. Who buys my research from me? Individual traders, top newsletter writers all over the world, and the biggest hedge funds and banks and brokerage houses in the world. My list of clients who buy research from me is like a who's who. And believe me, they don't pay big bucks to me for their health. They pay it for good information. No guarantees. We're not perfect. We don't make money all the time, but we do have specific strategies, and I'm going to teach you a couple of them today. A few things to remember. Small traders take small profits and big losses. Most trading accounts that begin with less than $10,000 will not last for more than a few months. Most traders lose their discipline after 3 consecutive losses. Why is that? Well, remember, a lot of new people have come into the market. They don't understand how the markets work. They make a trade, they lose money. They say, "Oh, it's okay. I'm not expecting this to be perfect. It's okay to lose money once. I'll try it again." They try it again. They lose money again. See, well, I read somewhere that it's important to be disciplined. So they have discipline and they say, "I'll take it a third time." They take a third trade and they lose they lose money 3 times in a row. So now it's different. They're saying 3 times in a row, I've run out of patience. This game has to work better. I don't like this game anymore. They change what they're doing and the process repeats. Now what they were doing before starts to work and they go back to it, and before you know it, they're all over the place. They don't realize that the big money is made in the big move. People love the small move. The big move is where we make our money, and big moves take time to develop. So for most people, day trading is not the key. Short-term trading helps, but intermediate to long-term trading is even better because that's where the big money is made. In addition to that, most traders make their trades based on feelings as opposed to facts. Always try and differentiate between what you're feeling about a market and what the fact is. You need to be clinically dispassionate, by which I mean you need to not care about making money. It sounds counterintuitive, doesn't it? The more you care, the less you make. Most people don't understand the origin of discipline. They say, you know what, I figured out why I can't make money. I can't make money because I'm not disciplined. I was talking to somebody and he said, discipline is the key to everything. I read Jake Bernstein's book in 1984 about trader psychology. It's all about discipline. Ladies and gentlemen, don't read that book. That book was all about psychology. Discipline is primarily not about psychology. Discipline is about confidence. Confidence is about knowing what you're doing. Knowing what you're doing is about having strategies that work. Having strategies that work is having strategies that are clear and concise. That takes time and research and rules. So based on my experience, I estimate that 80% of traders are absolutely unable to consistently follow any trading methodology, no matter how clear it may be. So the bottom line, the more money you make, the less you care. You can't care. How can that be possible? Really simple. I like to take my losses before I make the trade. So in other words, I put on a trade. I assume that my loss will be $4,000 depending on my stop. I take that $4,000. I deduct it from my account. It doesn't exist anymore. Then whatever happens is not an unpleasant surprise. So that's just one little tip that I use. Now look, I'm going to give you a list on these next two slides. Please, if there's nothing I can do for you today, there's only two things I want to do for you today. If I can do this list, and then the trading model, which I will show shortly, that will be the key to everything. I always want to know what to trade, exactly when to buy or sell, the time of day to buy or sell, or the price, my odds of success, my average profit, my average loss, my stop, my profit to loss ratio. Am I making more money when I'm winning than I'm losing when I'm losing? My complete track record, my average profit, my average loss in points and percent, my largest profit, my largest loss, my maximum drawdown, my maximum upswing. In addition to that, max consecutive profits, max consecutive losses, and so on. Excuse me. So check it out and think about this. Do you know all of this information before you make a trade? If you don't know all of this information before you make a trade, you will eventually reach the point where you're not making money at all. One moment, ladies and gentlemen, I'm just going to get a drink of water. I'll be right back. Okay, we're back. So some of my favorite indicators: seasonals, patterns, moving average channel, COT reports, cycles, divergence, and 8 open close. Obviously, I don't have the time to cover all of these today, but I will show you some of them. Before we do that, I want to say something really important. You're going to either believe me now or you're going to believe me later, by which I mean this. Over the next 3 to 5 years, probably sooner rather than later, everything in technical analysis will change. The traditional things that we're using will not be using anymore. Rather, we'll be using artificial intelligence. Everything is going in the direction of AI, and pretty soon, if you're not consistent with AI and you don't have that as part of what you're doing, you're going to be left behind. So remember, it's not about what I can teach you right now. It's what you can do with what I teach you that is going to make a big difference in your trading. So let's go forward. And let's go back to this. You need to have trading structure. The trading structure consists of 3 parts. Part number 1, setup. A setup is a pattern. Price showed you some patterns in his work. I'm going to show you some patterns in my work. You need to have a pattern. Once you have a pattern, that pattern has to trigger. So for example, the traditional patterns, head and shoulders, key reversal, flags, pennants, breakouts, blah, blah, blah. We really don't know if they work. If you take them to the computer and you ask the question, do they have predictive validity? Do they predict anything? You'll find that for 95% of these indicators, they predict nothing. So a setup, if it's been effective, has to have a trigger. And the trigger says, yes, this indicator is suggesting that this pattern will happen now again. And so I've increased my odds from 75% to 79%. Doesn't sound like much, but it makes a big difference in the market. Once a trade triggers, you need follow through, which consists of two parts. Actually, three. Part number one, where am I wrong? In other words, my stop loss. Part number two, my profitable target. What is my target and what do I do once I get there? Once I get to my target, I take 1/3 of my position off the table and I trail a stop on the remaining 2/3 in order to maximize the profit. So the third aspect of part three is profit maximizing strategy. So let's use an example. You've probably seen this example before if you've seen my work. One of the best books ever written about trading was written by a guy named Art Merrill called The Behavior of Prices on Wall Street. Merrill showed that on the day before major holidays, the Dow Jones closes higher on the day. So for example, in USA, Thanksgiving is on a Thursday. You would buy on the close Wednesday, get out on the close Thursday. It's a one-day trade, probability of success very high. You can take this strategy and apply it to set up, trigger, and follow through. And the rule is very simple, which I just stated for you. But no matter how simple the rule is, people will generally find a way to screw that rule up royally. We try not to do that. So being the computer and numbers guy that I am, I ask the question, how accurate has this been? And is there a way to make it better? Is it possible that this pattern actually begins before Thanksgiving, not just one day? Because if it begins before Thanksgiving, maybe a week or two, and we're in the trade for longer, we can make more money. Because remember, there's a relationship between how long you're in a trade and how much money you make, except, of course, if you're in an option that's losing value. So this pattern, in fact, these pre-holiday patterns, the holidays before, the trades before New Year's Day, Christmas, Easter, July the 4th, etc., Labor Day, these go back to the late 1880s and they can be tested. And if you look at the statistics, they can occur by chance only once in 10,000 times. And no matter how long we continue to talk about these, and I've been talking about these patterns for decades, they continue to work, which flies in the face of contemporary logic, which is, if everybody knows it, it's not going to work. And I'm going to show you some of that. So it's not a supposition. It's not the Elliott wave theory. It's a fact. And because it's a fact, we can prove it or disprove it. So Memorial Day. Here's the Memorial Day trade right over here this year. People would look at it and they say, well, and by the way, this is Memorial Day. This is the day before, and this is the day before the day before. You'd be buying here and getting out over here. And people would say, but why didn't you buy it here? No problem. That is part of a different methodology. If we used a different methodology, which was not focused on this, we would have bought it here or maybe here. So the bottom line is, use the strategy that you've tested and trade that strategy without regard for anything else except for stop loss and risk. So if I do this, go to the computer, and I'll show you how to do that, and ask the question, show me trades in S&P that begin before Thanksgiving, before Memorial Day, and maybe end after Memorial Day. And here's what I get. Computer does a great big search of a whole bunch of numbers called big data and comes up with this right over here. It says buying end of day May 23rd, getting out end of day June 5th with a risk of 2.5% stop close only, has had a PO ratio of 3.5 to 1, 74% accuracy, average profit, average loss. Everything you need to know about this trade historically, including the history of the trade. So the question is, were you lacking information? The question is, would you have been able to trade this with an option? Sure. The option would reduce your risk. It might reduce some of your profit, but it certainly would give you maximum leverage. So here's the trade as it was as of last year. Very simple. And what's interesting is this. Last year, it produced the biggest profit ever. Even though it's been advertised by me repeatedly over the years, it still produced its biggest profit. So people would say, it's not going to happen again because of this, because of that. Here's the trade this year. Within a matter of days, it reached its target, and then it went on to end up over here. So here's the profitable target reached right over there very quickly in a matter of days. So the only thing that you'd be concerned about is this. If you're a completely consistent trader, all you care about is the facts. So let's do this. I'm going to show you something else. I'm going to switch screens for just one moment, please, and start a new share. One moment, please. I'm going to go here. Can everybody see my screen for Seasonal Trader now? Okay, good. Thank you, David. So look, I'm going to log in here for just a minute and show you something. So I'm logging into TradeOutLoud.com. You can get a free trial at a link that I'm going to give you. I'm going to do a search. I'm going to search seasonal trades in stocks. And just for the heck of it, I'm going to go to Apple. I'm going to ask the question. One moment, please. Here's Apple. I'm going to ask the question. Historically, in the month of July, have there been any trades in Apple that have been right 75% of the time or more with less than 10% risk? So I'm putting in my search parameters into this huge, huge data bank and asking the computer to find me patterns if there are any. Computer comes up with this. Yes, there has been a pattern. And the pattern says, historically, buying Apple stock on the close of trading, July 2nd, getting out July 15th, has been right 80.6% of the time, with a PO ratio of 49 to 1, meaning in sum total, it's made 49 times as much money as it's lost. So I have here all the statistics. Average profit in percent, average loss in percent, and of course, I've got the entire history right over here. Every trade, every year, all the way back to 2020. Complete track record. Now look, this is a perfect opportunity for people to use psychology and say, oh no, look how well it's working. It's gone parabolic. It can't continue to work. Or they'll look here and they'll say it's had 1, 2, 3, 4, 5, 6, 7 losses. Well, so what? It's had 7 losses over the course of many years. How many years? Right over here, 36 years. So if you can find something with a track record, 36 years long in what you're doing, that will give you the answers to the questions that I posed earlier. When to get in, when to get out, blah, blah, blah. That's great, but you won't find it most of the time. So how to do this? Well, even though the accuracy has been very strong at 80%, we can still use a trigger. I will show you some triggers later on. In fact, I'll show you my favorite trigger. And the trigger basically says, I am now able to boost my accuracy by a few percent, which makes a big difference here because the market is going in the direction that we expected it to go. So let me take you back a little bit. Here you go. What if I said, let me try differently. Just one moment, please. Okay, so here's the trade. What if I said, does this trade actually begin before July the 2nd? I go back to June and I see another one. It really starts on June the 29th. So we're in it for a little bit longer and maybe we make more money. Let's look at the history. Here's the history of the trade right over here. And we look at the performance graph. Not bad. Didn't make as much money as the other one did this year, but still we have choices and we can adapt those choices to the degree of risk that we want to take. But we can do something even better. Let me show you that. I'm going to come back here. We can look at what's called the seasonal chart. Let me show it to you. This chart is very simple, and let me explain it to you. I took every year of Apple stock since 1981 and made one chart that shows the typical year in Apple. And you can see that the bottom tends to come in June, July, and from June, July till the end of the year, it tends to go higher. In fact, this bottom is often preceded by a decline. So we know exactly what to expect. These little arrows up and down indicate high probability weeks up or weeks down, showing the percentage of time. Very important chart. And what I can do is I can click on one little area right over here and turn this into a daily chart, which shows the daily up or down percentage on the chart. Example, June 12th, 13th, 14th through the 17th has generally been a down period with these percentages. Now remember, these percentages are certainly nowhere near 100% or even 80%, but they show you the bias of the market. And by combining this information with a timing trigger, because remember, this is a setup, it's not a trigger yet. By combining this information with a trigger, we end up with a higher accuracy trade. So we can do all of that at seasonaltrader.com. So let me come back to the charts for a moment and show you something else. One moment, please. And return to search. So I'm able to search not only stocks, but futures as well. And I have a list here of these stocks that have historically had the highest probability of success. So what we're doing is this, we're predetermining those stocks that we want to trade in whatever way we want to trade, and by which I mean options or option spreads or stocks, etc. And in addition to that, we're doing a search to find out if there's a pattern. So for example, just randomly, if I pick McDonald's, like so, and I say, are there any trades in July with 70% accuracy or more in McDonald's? In fact, let's make it 75% for the month of July. If there's something that meets those characteristics, it'll find it. And in my lo and behold, it has. Oh, it's Apple, sorry. Let me come back. Let me get rid of Apple. It's really actually very easy to use. It should be because I designed it. Here you go. Anything in McDonald's? It says no, so that's great. No information is just as good, if not better than some information, because it tells you there's nothing to do in that particular stock. Let me go to the chat because I think there's a question. One moment, please. Does the ST.com website let one screen for securities that are the most sensitive to season? Yes, it lets you see. In fact, those stocks that we selected are the ones that are the most sensitive to seasonals, and it shows what those patterns are. Good question. Are you scanning all stocks to narrow? Absolutely, we scan all stocks. In fact, I like to make my criteria very, very difficult to please. In other words, let me show you what I mean. Let me go back to the search. I'm going to pick the first 5 stocks. 1, I can do 25 at a time. I believe there's 50 or 75 here. It takes me about an hour a month. So we'll take these first 5, go to July, and I'll put in some very specific parameters. I want a win rate of 75% or more. I want a PO ratio of 4 or higher. In other words, sum total winning 4 times higher than sum total losing. I want to be in the trades for less than 25 days. So as you can see, I put in some very strict limitations on this, and let's see what happens. I get 2 trades, Abbott and Adobe. Abbott begins on the 16th, ends on the 30th. And here's why are there so many? The computer is basically stupid. It's given me everything I asked for, but I've programmed it so that it puts the best trade in the first position. Abbott of all these trades is the best one. How does it know? It takes the trade with the highest percentage accuracy, the highest PO ratio, and the lowest stop, and puts it in the first position. So there's really basically 2 trades here. Abbott, number 1 here, and Adobe over here. Adobe is a short position coming up. Well, let's see, it was on the 18th. We're going to check that out in a minute. And these are the 2 trades that it picked for the month. But remember, these are just trades that it picked. The trades have to trigger. So let's go, for example, let's come back to the Apple trade. The Apple trade was on the 12th, I believe. If you take a look at your chart, you'll see that Apple's been basically in a straight uptrend since then, and it's reached all of its profit targets. More on that later. We'll cover that more a little bit later. But before we do that, let me come back to the presentation before I get too far afield. We can also do trades in futures. And because we can do trades in futures, we can get all that information as well. So let's check it out. Go back here, return to search. And we'll go to futures, seasonal trades, US futures. And let me show you something interesting. Right now, there's been a big move up in Treasury bonds, Treasury notes. So going back to the search, before this happened, I said, show me trades for June and July in Treasury notes. Easy. In fact, I don't want anything less than 70% accurate. So I put it in right over here. And I do search. And what do I get? I get all kinds of trades on the long side. And I can sort by entry date. So I'm going to click right over here. And the first one comes up June the 1st and ends September the 4th. But you will notice it requires a risk of 100%, which means no stop. So I go back to my search feature and I say, I want to build in a stop because I'm not going to trade without a stop. I'm not going to risk anything more than 5% on this trade, like so. And here we go. Here are the trades and the entry dates and so forth. So, and you can expand or contract the time frame in anything you want. So you can try this for free and see if it works for you. The most important thing is it's by the numbers. There are no opinions here. It's strictly by the numbers. Let me go back to my main presentation. Just a moment, please. It's always a little bit tricky figuring out how to use this. Okay, I'm going to go back to share my other screen. New share. And let's go back to what I had before. One moment, please. PowerPoint. Okay, so if you want a free trial, can you see my PowerPoint screen now, everybody? Okay. We'll go full screen. Okay, so here we go. Let me make sure. Okay, thank you very much. Okay, so let me go forward. So let me continue with what I had before. I realize I'm jumping all over the place because there's only so much that I can teach you in 50 minutes and I have to be very selective. So let me advance this slide. Let's go back. I started out by showing an indicator in green. That indicator was the Commitment of Traders Report, COT. In my humble opinion, the Commitment of Traders Report is the most important piece of information you can have on any market, whether stocks or futures. The sad fact is that most people don't even know it exists. What the hell is it? Every week, the government puts out the COT report, Commitment of Traders Report, and in that report, it divides traders into three major categories: small speculators, large speculators, and commercials. Small speculators, traders who trade just a few contracts in futures. Large speculators, traders who trade more than a few contracts in futures. Commercials, the biggest group of traders who trade huge positions and account for about 95% of all the big trading. So, whose activity am I going to be interested in? I'm not interested in a small trader's activity, unless I want to do the opposite, which we can talk about another time. I'm not interested in the large speculator's activity. Why? Because this report comes out every week, and by the time we get it, it's 2 weeks old. So by the time you get the information about the large speculators and the small speculators, it's old information. But commercials, the biggest traders in the world, they don't change their positions too quickly because they're in the markets for a long time. So I want their information, and that's the only information I look at. Now, the report breaks down the statistics and says, for example, in the S&P market, of the 1 million contracts that are outstanding in futures, 500,000 commercials are short, 500,000 commercials are long. The net difference between them is 0. If 750,000 were long and 250,000 were short, the net difference would be 500,000. And so the numbers would show it's green on my chart, indicating commercial buying. We'll get into that a little deeper in just a minute. Looking at this chart, check it out. What do we see? So what we see on this chart is this. And in fact, let me go back to the previous chart. Going back to the previous chart, here we go. In platinum, before this move up, commercials started to buy platinum. I'm not saying that all the commercials were long, but there were more longs than there were shorts. So who are these commercials and how did they know to pick the bottom in platinum and start buying before the bottom came into place? The individuals, or should say, enterprises, corporations that are in the commercials category, are the biggest traders in the world who are in the business of platinum in this case. They mine the stuff, they produce the stuff, they refine the stuff, they broker the stuff, they use the stuff in manufacturing or whatever. So they are bona fide hedgers. Most of their activity is on the hedge side. They take the platinum out of the ground and they sell it on the futures to protect themselves. But when they start buying, they're out of character. They don't want to be buyers. They want to use the market for the purpose that's intended for, which is to hedge. But when they buy, we know they need the stuff. If they need this stuff, they need it for a reason. What would that reason be? Number one, they know the price is too cheap. Number two, they've got inside information. Number three, the demand from their end users who use the stuff is very high, and they don't have enough inventory, so they go into the futures market and buy and become net buyers. So, example, let me go back to the charts. Here's another example right away. Same situation, a closer look. What do we got? We've got commercials buying platinum close to the bottom and participating in a move that's well in advance, ahead of 30% over the next few months. How about this chart? Let me go to this chart. Just one moment, please. One moment. We'll come back to this one over here. So I'm going to go all the way back to the beginning again and show you this chart. What about this one? And remember, for practically every futures market, there's an ETF. So for example, if you're trading gold, there's GLD. If you're trading platinum, there's PLTT or PLLT, whatever it is. So I want you to look at this. I think you would agree that in the vast majority of cases, commercials get into moves before the big move happens. So using this information will give you an opportunity to zero in on the big moves. So why do I say this is out of character? So I want you to think about this situation, but don't think too much. Let's talk about soybeans. In the soybean market, you've got producers and you've got end users. Who's the producer? The farmer. The end user? The cereal company. The farmer who raises livestock and uses soybean meal in their food. The food companies that manufacture fake meat. These are all involved in the soybean market and a million other uses for soybeans. So when commercials, let's go back a little bit. The farmer grows the beans, harvests them and puts them in the truck and takes them over to the elevator operator and says, "What did you give me for my beans?" Elevator operator looks at the board of trade and sees that beans are trading at $13. He says to the farmer, "I'll give you $12.50. Farmer's not happy, but they haggle a little bit and they reach an agreement at $12.75. The elevator operator pays the producer, the farmer, $12.75 a bushel for their crop, and then immediately goes back to the office and looks at the board, the futures, and sees that they're trading at $13.10. He immediately sells at $13.10 the same quantity that he just bought from the farmer for $12.75. It's called making a profit. It's called capitalism. It's called screwing the farmer, whatever you want to call it. The bottom line is the elevator operator, the commercial, is now hedged. The farmer is happy. He got what he wanted. The elevator operator is happy. He's turning a profit. That's all there is to it. So when that sale is reported to the government, it's reported as a short position, but it is not a short position. It's a hedge position. A net long position, however, is very different. It means they need the stuff. They don't have the stuff. The only way they can get it is to go to the futures market and buy, hedge that product. So then if we go, let me go forward a whole bunch of charts. I'm going to skip over a whole bunch of stuff here because I took basically what's a 3-hour presentation and condensed it into 1 hour. Let me show you a situation here. So just stay with me for a moment. Let's take a case example of the COT. And by the way, here's some recent recommendations I gave based on the seasonal trader. We had these 3 trades a couple of weeks ago in one of my reports that I sent out to people. Costco, Apple, and General Motors. Well, you know where the Apple trade came from. This is what happened. The Apple trade and the Costco trade both triggered. What's the trigger? Real simple. I'm going to confuse you for a minute, so just bear with me. This is the Costco chart. This was the day of entry on the Costco chart right over here. I looked at this indicator here. And by the way, this is one of the best indicators you can use for short-term timing. I call it the 8 open close. I'm taking an 8-day simple moving average of the close, an 8-day simple moving average of the open. Close, open. If the 8-day simple moving average of the close is greater than the 8-day simple moving average of the open, I have a buy setup as the seasonal, and I get a trigger. This trade is good to go. This was the duration of that trade, the entry, the exit. And after the exit is over, I place a trailing stop. The trailing stop is in blue. It's a 3-day moving average of the low. So if I close below my stop, I'm out of the trade. So this one, as of the chart, as of the time this chart was made, is still in a long position. Let me show you another one. This was the Apple trade right over here. Entry date, target number 1 is hit, exit date, and then we implement a trailing stop, 3-period moving average of the low. It's really very simple. And as I said before, I can't teach it all to you in one session. I see some questions in the chat, so let me take those before we go on. I don't want to lose anybody. A lot of drop-down boxes for stock question. Can you choose all of them and get the result? Absolutely. And by the way, there's a tutorial there where you can learn exactly how to use it. So if commercials are selling, they're hedging their book. And if they're buying, it's a buy signal. If commercials are buying, it means if commercials are selling, they're hedging their book. That's correct. If they're buying, it means they need the stuff. So just bear with me, Stephanie. I'm going to show you an example of how that works. And I realize this is very different than the work that many of you may be accustomed to, but let me show you what I'm talking about. Let's take an example. A couple of years ago, we predicted a big bull market in Starbucks. How did we do that? Let me show you. Just hang on a second. Oh, by the way, let me do this before I get too far in the woods. This is the current chart of the E-mini NASDAQ, COT. I've put a vertical line to accentuate where the COT net buyers were. In other words, they were buying here, they were buying here, they were buying here, net buyers. I want you to look at what the COT commercials were doing during this up move that we've been in and still are now. Think about it. For the last, month, 6 months, 5 months, whatever it's been, they've been net long practically every week. So throughout the course of this wall of worry that COVID's been climbing the wall of worry, the predictions, the forecasts, and all the rest of that stuff, commercials have been net long the market. Interesting? I think so. Let me get my pointer back because it has disappeared on me. One moment, please. So right over here, they've been net long and they still are. Remember, commercials don't get net long or hedged or short anything unless it's for the intermediate to longer term. Let's go forward. Let's go back to this right over here. Check this one out as well. Here is the most recent up move in soybean oil right over here. Probably one of the biggest up moves in history. What were commercials doing before it happened? They were big buyers. In fact, they bought more soybean oil than ever before. But remember, for commercials, timing is not as critical as it is for us human beings. We need timing. So this gives my setup, and then we go to a timing trigger. But let me go forward because I have one more thing that's really important. I want to show it to you. So think about this. Hold on one moment. I'm going to go there as quickly as I can. Let's do this. Here we go. Think about this. Starbucks. What are the ingredients of Starbucks business? The main ingredients: coffee, cocoa, milk, sugar, the cost of money, labor costs, and rent. If we know that Starbucks is able to buy hedge some or all of these at low prices, we know that they're going to make a ton of money because remember, on the retail level, prices rarely go down. So if I go, for example, to this chart right over here, coffee futures, based on what I just taught you, what was happening in coffee futures in 2018 and through 2019 and into the end of 2019? You had the largest commercial buying activity in coffee futures in many years. In addition, that happened here and that happened here, but let's forget about that for now. This was the longest stretch of buying activity. So knowing that commercials such as Starbucks are the biggest buyers in the business, and they're the ones that are the commercials in this market, we knew that Starbucks was buying. Okay, what else? Believe it or not, there's also milk futures. I don't trade it. I never have, probably never will. But we also know that there was a cyclical behavior in milk prices, which was at its low in 2018, right over here, and another low in 2020. Furthermore, we knew that sugar prices were low and that commercials began accumulating sugar over here again in 2018. In addition to that, we knew that commercials were buying, hold on one moment, please. In addition to that, we knew that commercials were buying cocoa in 2018, right over here, 2017, 2018. In addition to that, we knew that commercials were hedging the cost of money. How were they doing that? Easy. They were buying interest rate futures. Because remember, as interest rate futures go up, interest rates go down. So we had, no puns intended, all the ingredients for a bull move in Starbucks based on what? Based on the fact that they are very intelligent about buying their inputs before they need them, and that $5 cup of coffee is going to become a $6 cup of coffee when prices start going up, and Starbucks is going to tell you we need to raise prices because prices are going up, not telling you that they've already bought their coffee a year and a half ago, their sugar a year and a half ago, and buy hedge their other production needs a year ago. And so what happens? We take that information and we look at the Starbucks chart. So this was Starbucks in 2018, knowing that even though the stock was going nowhere, there was not only a cyclical pattern in the stock, but most important, and you can forget about the cycle, most important, their cost of inputs, their cost of production was extremely low. Knowing they'd make money, you buy the stock with timing on the stock. The same pattern repeated in 2020. They were buying cocoa, coffee, sugar at low prices and milk at low prices. Therefore, bottom line profits increase. So let me show you a couple of more things. One moment, please. Using a trading and timing method that we have developed over the years called the moving average channel. We went long, Starbucks here. These are the buy setups and buy triggers, and all the way up, there was support at the bottom of our moving average channel, which I can teach you from my webinars, and that's how the thing played out. So remember setup, trigger, and follow through, and you can come back and I'll send this presentation to David. If you need it, you can just contact him and he'll send it to you. So you can look at this at your leisure. In just one moment, please. So again, I give these specific recommendations. These were the trades that I gave just a couple of days ago. You'll notice that Autodesk was a short position. And what happened to Autodesk? It crashed almost immediately and reached its profit target. The profit target is very important. So for stocks, the first profit target is the percent average profit. So Autodesk immediately, the very next day, reached its first profit target. The others are still open and reaching their targets, but haven't been stopped out. So here's what I'm going to do. I've got about 8 minutes left. I'm going to give you my email address, my websites, and so forth. And I'm going to take questions now. I'm going to go to the chat, open up the questions. Jake, are those charts with COT data available to US traders, to us traders? Yes. COT is available on most charting services. And don't get confused. The important data you want to look at on the COT is the COT commercials net positions, net long positions, okay? Now, some charting platforms do not chart it. You have to look at the raw data, but the raw data is available free of charge from the USDA, Commodity Exchange Authority, and so forth. Okay, any other questions for me? Okay, so let me wrap up. So what I had to show you today was very clear and very specific, not based on opinion, but based on facts. If you like to trade based on facts, fabulous. You can do it with my work. SeasonalTrader.com gives you many facts. All you need to do is implement them specifically and according to the rules. Let me show you one more thing. In fact, let me go back to my presentation if you're interested. So at SeasonalTrader.com, we have this thing entitled How It Works. You can get some information there on how the process works. There's also a section entitled let's see, what's it called? It's called, one moment, please, let me remember. It's called Seasonality 101. That will explain to you everything I've explained to you today in greater detail. And if you have any questions, you can write me, Jake, at trade-futures.com. And David, I'll turn it back over to you in case there's things you want to say or anything you want me to answer.